crash right now. So it's looking quite different from what we saw in 2017 and the cycles before. Yeah, it's quite interesting, this whole cycle. I've never seen anything like this before. Yeah, I think it's structurally still intact. But, December was, I'm told it was going to be soft from the institutional money. They want to cash out and book their profits, and a lot of the guys that want to redeploy. I'm hearing that that's kind of a January story. So, and also we've got the tax sell-off kind of regime right now. So these sort of news and narrative fundamentally weak for December. But, if we're looking over the next 6 months, structurally, it's pretty strong. And, what gives me confidence about that is that there's really a lot of coins that have been moved to long-term holders who have held their coins for 5 months or more. And so they're at maximum accumulation. They're slowly divesting as they do, as the price runs up and they take some profits. But predominantly, the coins are with the long-term holders, and bear markets don't usually start until the long-term holders are divested and they're now in the short-term holder sort of category, where those weak hands are much more prone to dumping or selling out. And the last sort of crash we had from the low 60s to eventually the 29,000 was when those long-term holders had completely exhausted. And so we're currently pretty charged up with those guys holding onto their coins. So depending on how quickly they divest, I think we've got anything from 3 to 6 months of a run, maybe longer, just have to see. Exactly, and we're not really tracking individual participants in that kind of model. So I see it as like different waves of people coming in. They come in, they hold, they wait for the rally, they take their profits. And if you go back and you look at 5 months from now, that was really in the $30,000 range after it dumped. And those guys, held up to now and they're divesting and taking their profits. And it was very similar the last sort of 5 months. So these alternating cycles where new people come in, they get the run, they sell, and then people buy into the rallies, and they experience the dump sometimes, and then they get their turn. But in this case, there's other data that I'm looking at that's it's showing. It's the guys that dumped at the 60,000 when we went down to 29 back in May. They were these kind of people that were accumulating, and then they completely dumped out. And now with more of the forensics metrics and supply shocks, where we can actually see the different categories of holders, a whole lot of strong-handed accumulators were lost, and then they sort of popped up in the speculative swing trade sort of metrics. So I think what's happened is a lot of the smart, well-backed money, whether they're hedge funds or family offices, did buy the $10,000 range and into 20,000, sold at the 60, and they reaccumulated as it was coming down from the 40s to the 30s. So we've got a lot of, seems like sophisticated swing traders now that are playing the market. So it's looking quite different from what we saw in 2017 and the cycles before. Yeah, it's quite interesting, this whole cycle. Never seen anything like this before. I think if you were to look back in the deep history of geological Bitcoin time, really the early guys were the techos, the guys that mined it. And then, we had the Silk Road and so forth. We had the libertarians. The very early smart money, I think, came in 2016-17 when it started, Bitcoin articles popped up around the Winklevoss ETF in 2017. And then we had the derivatives come in with BitMEX and mention of the perpetual swap. And by, I'd say, 2019, 2020, we had the infrastructure here for institutionals. And so now we're really deep into this, where we've got family offices, we've got large hedge funds, mutual funds, now sovereign wealth sort of coming in, like El Salvador's the first sovereign nation to accumulate. And so it's a lot different, and the instruments are different now. We've got not only the perps, but we've got very well developed options and futures markets. Well, options aren't quite as liquid, but they're coming, and you've got the ETF that backs onto the CME. like a regulated US exchange. So a lot of institutions worldwide are deploying through like futures instruments because it's fully regulated and it's very easy for them. So I think that's the whole thing's changed, right? And how that demand and supply filter through to the underlying asset is through a different chain. Anyone who's been in the market since 2018 has noticed that the price shape has changed and the moves are very sharp and the liquidation events, and that's a signature of futures being dominant. And so it's a very different kind of environment now. Yeah, it's much more complex. There's something that has definitely changed. We're constantly seeing more and more coins move off the exchanges. The weird things happening, right? Prices aren't following. I use Glassnode data, and they have something called liquid supply. It also measures, it kind of does a forensic trace of all of the participants and figures out all the addresses and goes, oh, that's one person, that's one person. And then let's look at their history, and they can kind of categorize the guys that aren't selling and the guys that are semi-selling and the guys that are totally speculative and then wallet activity. And it used to be for a long time the illiquid guys that are just stacking was very correlated to the exchange balances. Like as more and more coins went off the exchanges, they were actually illiquid supply was tracking that very closely. But nowadays it's not. There's a divergence. I'm not sure what that is. Maybe this new animal of swing traders they're pulling off to the exchanges. I'm not sure yet. But if you when I look at supply shock, I really look at the illiquid supply. We've got a forensic trace of their behavior, and we're not at the levels we were prior to May. It looks like that if you were to run the calculation using Glassnode's workbench, but there's some amount of drift that happens with that data, because if you think about how if you were to withdraw money into a new address, you have no clue whether that's a new person, and eventually you go, oh no, that's Bob. We can see that now, so it wasn't a new person. And so you'll find that it's over optimistic as coins moving into a new wallet that's obviously liquid because you've never seen them spend those coins, and then later you go, oh no, that's Bob, someone we know. And then so there's a natural drift down in the liquid supply as that data hardens up. Like if you were to run the calculations, it says we're at an all-time high of supply shock, but if you account for that drift, which I do, it's surprising. We're about the kind of supply shock we had back in January, December, back when the price was maybe 40,000 to 50,000, I would say 50 to 55,000, 45, let's say 45 to 55,000 is the level of supply shock that we're historically at. Not at all-time high, nothing like we had at say March of this year. It's been strengthening, and just prior to the recent dip, there was a little bit of softening in that supply shock, but nothing to say we're going to crash right now. So I'm waiting for that to strengthen a lot through to January.